weekly podcast, The Lens, with Craig Shapiro and Larry McDonald. This week, we have great insights from our Bloomberg chat, our Discord chat, and Larry went to Washington to visit some clients, some people at Treasury, and we have great intel just for you. Remember, if you're interested in any of the reports mentioned all throughout this video, you can reach us at info@thebirdshopsreport.com. And I have great news for you guys. We're back in the top 10, and I've seen that some of you guys don't have our new bestseller yet. So get it now on Amazon and on the link below. Thank you very much.
Thanks, Valentina. And thanks to the whole team in New York. Great job this week, Craig. Thanks for running the show. Craig, so, I was going back and forth with clients. The big takeaway was through the week was the 2-year, the way bonds were acting. It was almost like they were telling you this jobs number is going to be soft. What were you hearing during the week, and what do you think looking forward?
Yeah, for sure. I definitely want to get into some of the insights that you got out of DC. But, we started the week kind of returned back to school, back to markets. September starts, and the long end is selling off for a day, for a minute. JGB yields making new 30-year highs. 30-year yields made, nearly hit 5%. Gilt yields, OAT yields. People kind of came into the month thinking, oh no, here we go again with the long end.
And gilt, that's
UK and France yields. And so, oh no, here we go again. We got to start worrying about, the long end and duration. And then you're right, as we move through the week, we started to see a bid in fixed income throughout the curve and then accelerated at the front end. And what we had all week really was labor data, various different types of labor data that were suggesting that the payroll print, which we saw today, which was a worse than expected 25,000 jobs, was going to be what we were going to get. So the 2-year had been rallying all week. We saw a worse than expected JOLTS figure, which showed an increase in layoffs and a decrease in job openings. We saw initial jobless claims make 6-week highs. The employment indicators for manufacturing and services ISM both under 40.
But Craig, everyone's been saying the economy's re-accelerating for the last 3 weeks.
Yeah.
Every economy, like the whole street is being saying the economy is re-accelerating. What happened?
I think what people got lulled into was the price action in markets, right? And so, and what we know is when, price creates narrative. And so when stocks are rallying to all-time highs and volatility is making, new lows for the year, which is largely what we got through the end of August, and shorts don't work and small caps are working, and really everything is working. People saying, well, the market knows something. And so clearly the economy is in a better place than we think. And the Fed is going to be cutting rates into an economy that doesn't need it. Right. I think that was largely the narrative we were getting from clients through the end of August. But look, when people kind of get back to work and the varsity team is back at the seats, which is what happened starting Tuesday, investment committees meet, portfolio allocation decisions are made to shift out of summer mode. And so people had to really step up and think about whether or not the economy and the labor market in particular was showing signs of increased deceleration and slowing, which is what we saw last month. And clearly, what people had been starting to get more worried about as the days progressed this week.
Right. And look at that 100 basis points of cuts in the two. So if you look at the 2-year yield versus Fed funds, this is just the most simple way to look at SOFR futures. In a simple, if you don't want to get into the weeds, this is just really simple. It's 100 basis points of cuts over the next 2 years. If you look at 2 years in Fed funds, and that's like on the largest mark. So this is the biggest spread, almost the biggest spread between the 2-year yield and Fed funds. And, I thought, the S&P is trading at all-time high multiples, or be near all-time high multiples. The Cape PE, or if you want to call it, the Cape, if you measure the earnings value of the S&P, the Cape, like 30-year mean is 50% below where we are. So clearly the market's equities are pricing in a lot of growth, but yet the economy is slowing down. That's justifying lots of cuts. Like, what gives?
No, I think it's been a confusing situation for market participants to really understand, because what we have is, this dichotomy between this K-shaped economy, right? certain parts of the economy are doing incredibly well. The wealthy, cash-rich companies continue to outperform and to perform, and to do great. And more, interest rate sensitive parts of the economy and low-end consumer are struggling. And so, depending on kind of where you sit on the fence determines whether or not what your outlook really is. And with stock markets basically making highs, I think there's this expectation or belief that, well, the Fed is cutting rates into an economy that is fine. And
Right.
so that rate cutting cycle beginning just adds more liquidity and is going to be more reason to get more constructive. The question really is the economy fine? And is the rate cutting cycle going to be enough to arrest the deceleration in some of these weaker parts of the economy? So I think we've been back and forth on that narrative. And I think what we've gotten more data this week suggests that there is more concern about the pace of growth. There's more concern about the labor market momentum than before. And so, we're bringing up some questions as we head into next week, another important data week with the inflation data coming out, because the inflation data will dictate really how rapidly the Fed will be able to cut rates. And we know inflation has been reaccelerating, over the course of the last several weeks. And with the tariffs and with some of the services inflation kind of continuing to move higher, headline CPI and even core CPI next week is, maybe as high as 3% and moving higher into the month of September for October, makes it harder for the Fed to justify aggressive cuts. As some people are talking potentially for a 50 basis point rate cut even in September. I mean, with a very hot inflation print next week, how does the Fed justify that narrative? I don't think
Right.
It's going to be very hard to do.
And, in being at Treasury this week and seeing the clients, on the Hill, talking to, the right people and asking the right questions. One of the points that gets brought up in meetings in Washington is, say, the UK, the growth is slowed to less than 1%, but their inflation target is double. And the inflation is double the target. In other words, that's real stagflation. And so if you look around the world, so think of that slowing growth, but sticky inflation. And in the UK, it's much worse than the United States because it's double their central bank target. And in that kind of world, that's where hard assets start to outperform. In our book, How to Listen to Markets Speak, the whole layout is that kind of shift from financial assets, which are just paper certificates, bonds, tech stocks, growth stocks, over toward look at long duration equities. We'll talk about that later in the segment. But look at long duration equities like software. It's not just AI disruption. It's this long duration in a world where you've got more stagflation potential. So we've been buyers of the TLT and trade alerts. Craig, we're getting a lot of requests from clients globally. They want a weekly piece. That they demand a weekly piece that looks at the entire issuance that's coming out of Washington, the budget, everything in one place. We created Washington pressure points. People should reach out to us. You got to get a copy. It's for people that are really interested in the bond market. Washington pressure points takes everything, puts it together. Next slide. Thanks. But Craig, one of the things that people are talking about is that term premium globally versus the United States. So all that means is people are worried about the long end globally and that term premium expansion in the UK and France versus the United States. It's widening out. And all that means is people don't trust long-term bonds as much. And that's been supportive of gold miners, copper miners, companies that own assets. And as you can see here, high yield, is not confirming the highs in equities. You're not getting tighter spreads there. That speaks to what you're talking about around the economy.
Yeah. First off, on these term premiums, what you have is threefold issue for the long end. One, you have fiscal deficits globally expanding. So not only in the U.S. but now in Japan, in the U.K., in Europe broadly, as more countries now are being forced to spend more on domestic infrastructure, on military spending, and a variety of other social programs. Their budget deficits now are starting to widen. There's concerns about a reacceleration of inflation and various money printing. And then there's a concern about central bank independence starting in the US, but also globally. So those things, broadly speaking, are making it more difficult for investors to feel comfortable that they're getting adequately compensated for owning 20 and 30 and beyond duration assets.
Right.
And so you have 30-year yields in the US hitting 5%. You have JGB yields out 30, 40 years, north of 3%, north of 3% in in Germany as well, close to
UK
6%, 6% in the UK, right? And so
6%.
these are, and look, I mean, who even knows what the world's going to look like in 30 years? So when you think about, lending governments money that are going to be spending more in a more inflationary environment with more volatility and more geopolitical strain, supply chain build-outs, investors want to be more adequately compensated. That's been some of the pressure that we've seen on the long end. But on the short end, we're starting to see the rallies in the front, and so curves have steepened because of the slowdown. And I think this chart here on triple C spreads is kind of indicative of investors saying, you know what, the U.S. economy may be great, but it's not perfect. And should it really be spreads as tight as we've really almost ever seen, in light of some of the issues that we have, in light of some of the labor market deterioration, the AI build out that's coming, that's going to likely displace more workers. So credit markets are sniffing this out ahead of the equity market. Not surprisingly, it's typically what happens. For now, S&Ps and NASDAQs are holding in today, but I think as we move through next week, as people start to become a little bit more concerned about economic growth deterioration, I think stocks which are strong may start to struggle.
And Craig, there was a portfolio manager in the chat was talking about today. So we run a Bloomberg chat in a Discord room. Reach out to us at info@thebeartrapsupport.com if you want to get involved. If you're coming off an airplane, long meeting, Craig's right there for you and the team. And Craig, there was, I think, 3-1, 4-1 put activity in the HYG today relative to calls. I think that was one of the conversation points in this morning.
Yeah, it's really the first time we've seen a lot of put activity in high yield for quite some time. You're seeing it for September expiry, and then big contracts out, put spreads for October expiry as well. And so, whether or not this is credit investors hedging long credit portfolios or more directional bets on deteriorating credit environment, not sure. But with spreads as tight as they've been, in quite some time, and volatility in high yield, very compressed. I think these are smart portfolio hedge decisions that we're hearing more about in the chat, and so people are kind of starting to wake up on something we really haven't heard, for weeks, if not months, about any strain in the credit market. It just hasn't been there, and so for the first time, really in the last few days, starting to see early signs of that.
Right, and then J.P. Morgan. Sorry, the labeling on this chart is poor. But it's J.P. Morgan trading at 2.4 times book. But what's interesting is that clients are talking about that bearish weekly MACD roll. When you have that weekly MACD rolling, and when the rate of change, the direction of that MACD roll, the rate of change of it is fast. That's a pretty good bearish indicator. If you look at the XLF today, the financials are really giving way, which speaks to that, like you said. If it's rate cuts, great. But if growth's slowing down, that's not great for for some assets inside the bank portfolio, right? And then here this is your price to book of J.P. Morgan. I mean, it's just literally crack smoking area here. If you're long financials, Jamie Dimon has sold 30% of his position, and what moron, I mean, what idiots are paying 2.4 times book for JP Morgan while Jamie is dumping stock at his fastest pace in his career. You can blame it on his age or whatever, retirement next year. I don't know. It's the fastest pace he's ever sold stock, 30% at 2.4 times book. Jamie's saying, okay, guys, you want to buy JP Morgan at 2.4 times book? It's yours.
Yeah, 800 plus $1 billion market cap company, clearly the biggest, financial around, and a big component of the XLF. And so definitely, has benefited from passive flows. You've been talking about, distortions, in stocks and big cap stocks for months now, based on the passive dynamics. And so as long as there's passive flow into markets, these mega cap companies have done incredibly well and have way outperformed peers, and certainly look expensive versus history. The question will be, when does that passive flow start to stall out? What times of the month, what time of the year are we? I mean, currently, with other systematic flows, CTAs are back to all-time, basically back to record length. Vol control funds are close to 5-year highs in exposure on the long side. We know buybacks are in there now, but we start to lose the buyback support as we push through the month of September. And so we've lost some of that passive support. If we start to get some fundamental deterioration of data, we don't have the passive support anymore, we could start to see some larger moves and some corrections of some of these distortions in some of these companies.
And when you think of that sustained inflation regime, higher bond yields globally, hard asset type companies, gold miners kicking Nvidia's ass since the first quarter of 2024. You won't hear this anywhere on financial television. Gold miners kicking Nvidia's ass. I mean, Nvidia's up what, 6.5, 7% since November now after today. I mean, with gold up 50%. So think about that. This is a $4.1 trillion company trading at close to 30 times sales. You can buy all the gold miners combined for less than 500 billion, right? So all the gold miners combined are basically 500 billion, and Nvidia is up at 4 trillion. And so money is shifting here. You're seeing gold miners destroying Nvidia this week, this month, since 2024.
Yeah, we've been hearing more about the NVIDIA struggles in the chat, for the last couple of weeks since they reported, whether it was the news out of China with Baba having its own chip, or more recently from yesterday with OpenAI possibly partnering with Broadcom to create a new chip. Right, there's competitive pressures here on NVIDIA. There's also an announcement people were talking about earlier in the week. NVIDIA buying or renting back the chips that it had sold to one of its customers, Lambda, I think it is. So again, there's some cracks in the story when you have a $4 trillion market cap company trading at these egregious multiples, and a little bit of money comes out, it starts to filter in a larger way into other smaller parts of the economy. So you get a 10% correction in NVIDIA is a $400 billion market cap move. That money's got to find somewhere. Gold miners have been a huge beneficiary of that, as have other areas. But look, I think the gold story, we've been on the gold story. You've been on the gold story for a long time now. And, look, it's breaking out to all-time highs. It continues to be strong, but the support in the GLD isn't there yet. We're not really seeing the aggressive inflows. We're not really seeing the vol expansion or people chasing upside calls yet. So still feels like it has, some room to run here.
And, we've been lectured again about semiconductors and artificial intelligence. And here we have AMD like 8% below the 2021 high. I mean, think about this. I mean, hard assets are destroying semiconductors. I mean, you're talking about 3 years of dead money in AMD. And once again, you got you see that rate of change on the MACD. I think that's a weekly MACD. And that rate of change, that means a lot. When the rate of change, the sharper the move through there on the top right, that speaks to a lot of downside ahead. You can see that back in 21 and in 24, the big drawdowns for AMD came with those kind of MACD rolls. And, once again, hard assets destroying semiconductors. Next one, Jose.
Yeah, just to add to that, we had some commentary in the chat, this week about the 2000 analog, right? And people looking back to, are we starting to see some of the things that we saw back then with respect to free cash flow deterioration, with respect to, not doing proper depreciation schedules on CapEx. And, these are the types of things that, legendary short sellers like Jim Chanos and others kind of picked up on back in 98, 99, and 2000. And the same kind of guys are looking back and saying, this sounds eerily familiar in a lot of ways. And so, I think that's we're starting to hear a little bit more of that talking around to institutional clients. And so it's not a surprise that they're not removing their capital from the equity market, but they're shifting, they're rotating, looking for places where, earnings growth acceleration is there. And so things that are tied into hard assets, commodities, basic materials, have been picking up some of the, some of that capital.
Right. It's disgusting, right? It burns my fucking ass that the top 2 companies in the S&P, and nobody's upset about this, nobody's talking about, are 15% of the index. This is passive idiocy on roids. The last 30 years, the top 2 companies have averaged maybe 6 to 7%, maybe 8% of the S&P. That's what Jack Bogle wanted when he created passive investing, not this complete moronic, like literally like Jonestown. Everybody has the needle in the arm here. You can't have in the S&P 500 with everyone's 401k 2 AI stocks that are 15% of the index when the last 30 years That number has been around 6 to 7, maybe 8. It's it's just lunacy. No one's talking about it. And oh, by the way, these two companies that are 15% of the S&P are trading at 13 times sales and close to 30 times sales. That is a problem. Nobody's talking about it. It's the dark side of passive investing. Pick up how to listen when markets speak.
Yeah, I don't know if this is exactly the Barron's indicator or the contrarian indicator, but yesterday at the White House was a tech celebration for dinner. Right, Zuckerberg sitting at the right hand of Trump. Bill Gates was there. Amazon was there. Tim Cook from Apple was there. AMD was there. Representatives from Tesla and Nvidia were there. Right, it was this coronation of AI sitting in the White House, and Trump, Google was there, and Trump is, espousing about how great America is, a place to invest in AI. It just felt very top of market-y, that those pictures of him with them and talking about how great the stocks have been. And you pull back that last chart and you see, yeah, they have been great, but is this the time to celebrate, how great they've been, and what does that ultimately mean? And clearly, what we're seeing is investors looking for ways to shift capital away from them and try to find the next 10 baggers, the next 100 baggers, right? And so it's going to be difficult for Nvidia to go from 4 trillion to 8 trillion in a $30 trillion economy. But to take, the gold miner sector from 500 billion to a trillion, in a world of fiscal deficit expansion and inflation volatility and central bank independence coming under question, that seems like a more legitimate place to put capital.
Right. And speak about power. I mean, the great United States of America, we have a 50-year-old power grid, 30 years old in others. It's like a 90-year-old man. And we're putting all this testosterone, steroids, AI into it. And there's no power, Craig. There's no power path to the valuations of NVIDIA, Microsoft, and the hyperscalers. It makes no sense. This is look at say the coal names have been beaten down, trading 10, 15% free cash flow yields on some of these companies. But the coal names, the natural gas names, these are the companies that are going to power artificial intelligence the next 5 to 10 years. And the whole energy infrastructure needs to be built up. This is all part of our book, How to Listen to Markets Speak. But the coal names are ripping today, Craig. Have you heard anything from clients? Why are the coal names outperforming by so much today?
Yeah,
This is core natural resource, a big coal name.
Yeah, look, I think it's been, we've been hearing some about, oil is under pressure because of the OPEC supply increase potential. But investors still want to, figure out ways to be long energy and long U.S. domestic energy. So if you can't buy oil, you try to buy gas, which has been, a tough one, or you can buy coal. It's also benefiting from some of this rotation, which we've talked about, and some of the, the short squeezes, right? If I look today, just factor exposure, right? Most short index is up 175 basis points today. So there's definitely under the hood, we're seeing some weird correlation breakdowns and, alpha unwinds from maybe some crowded positioning. So, coal's typically a heavily shorted sector. No one provides a lot of capital there. And so a little bit of move in market cap can go a long way. And so I think that's what we're seeing there. But, keeping an eye out on, on coal, on natural gas, and other things that are going to power the grid. Because to your point, we're going to need we're going to need it all, right? We're going to need all fossil fuels in order to meet the expectations that the CapEx has.
They put Salesforce in the Dow Jones Industrial Average in September, I think, of 2020. I think it was right around that box there. They kicked out Exxon. I mean, these guys, such a classic telltale indicator. But once again, when you move into that higher interest rate regime, Craig, with higher inflation globally, it's long duration assets. Like a software company is a victim of AI, but it's also a victim of inflation in a long duration type asset. So you've got these cash flows that come from software, right? It's long duration over time. So over time, those cash flows are worth less and less and less. Whereas companies like Exxon that own oil in the ground, when there's an inflation regime, they outperform. As you can see, since we moved into the inflation regime in 2020, 21, we've had dramatic outperformance in hard assets, oil and gas, across the gamut, copper names. And so I just thought this is kind of the chart of the week, because Salesforce has had a very tough week.
Yeah, and look, I think investors are, becoming more hip to this idea, this rotation. We've been talking about it for months now, and the question, from here is how rapidly is the U.S. economy slowing, or is this just a little soft patch here, and we're off to the races, and a couple rate cuts are really gonna are going to work, because you're going to benefit from this capex build out, this AI build out that's in the pipeline, that's coming. Um, it's still TBD. I think again, this week was a tough week for those who believe that the economy is all good. But we've seen we've seen some the data being erratic, let's say, over the last several months, with the tariffs and the coming on, coming off, and we know the administration is going to keep trying to pump the economy and do whatever it takes. There was talk this week about, I'm not sure if you heard any of this in DC while you were there. It'd be interesting to hear, but just about this housing emergency, right? There was talk that the government wants to declare housing an emergency, right? Because prices are too high, and there's unaffordability issues. So curious if you've heard anything, Larry, on that front, whether or not the administration is pushing forward with anything more specific on the housing front.
Right. Yeah, I'll get to that. Thank you, Craig. And I want to bring that up. I just want to say that, just in closing, copper's been a very large component of our high conviction portfolio. Copper and gold and silver miners are a very, very large part. Our high conviction portfolio has doubled the S&P over the last 12 months. And as you can see here, copper names destroying the Qs since 2020. That was a very low point for the copper names. But as you can see here, we're going to break out this week. Trade alert breakout on the copper names versus the Qs. Very bullish copper story, which we get into in the book. But yeah, Craig, you wouldn't believe, in Washington. So the clients, what we do is we had meetings in Treasury, then we had a lunch where the clients discussed, their takeaways from the different meetings at Treasury. And you're absolutely right. This home affordability situation into the 2026 midterms is probably the most important concern of, I think, the Percent team, and I think the White House. Just naturally, when you go into the midterms, you want to see homes more affordable. And it's very interesting that the long end, and you get this rate rally, and there's an index which they have around affordability on the Hill. And so if you think of like 100 as affordable, the norm is 85%, and that's more affordable. We're up at like 125%. And so all that means is homes are the least affordable. Right now, a young couple in their 30s can't even buy a home. And there's a formula that came out of a lot of the meetings, where they look at the price of homes, they look at the price of homes, they look at the interest rate cost on the home, right? So there's a formula around, okay, you got the home price and then the interest rate cost on the home. And so if they can get rates down, and then there's the income. So there's three. So think of a family. You get your income. So if your incomes, if the White House can get incomes up a lot, 10%, that helps affordability. If they can get home prices down, that helps affordability. But if they can get rates down, then that's the one thing they can probably control. And I think it's imperative that, I think the White House is very concerned going into the midterms, that home affordability is so egregious right now. And I think that's a top I guess initiative, or I guess focus inside the White House.
Yeah, I think the question will be, as the Fed is cutting rates and interest rates are coming down, are we going to see a similar decline in long end yields and in mortgage yields, and at the same time see housing prices come down, right? I think there's many people who believe that as we bring down mortgage rates, housing prices, may go back up again, right? If people start to think about money printing and a weak dollar and a store of value in homes. And so are we going to get those house price declines? I mean, I know down here in Southwest Florida, we are getting, in Florida, generally speaking, and then there's other areas where inventory of houses is very elevated. So I think if the administration is just patient with this, right, I think they will ultimately get what they want. And the question is, can Trump actually be patient? I don't know. We saw him try to be patient earlier in the year about tariffs, and then he kind of threw that patience out the window. But I think if the administration just kind of pushes it here a little bit and says, look, the Fed's going to be cutting rates. We're going to have a housing price slowdown. It's going to be okay. Let's just let this play out. If instead though the administration really starts to push on the Fed and tries to force rates down, and we know Lisa Cook, the issues there, whether or not she's going to be here or not, we don't know. It looks like Steve Marin's going to be approved, maybe even as early as the end of this week, end of next week, which will get him there for September. But if the administration pushes too aggressively, then you have dollar weak inflation expectations moving back higher, house prices don't fall, and then affordability is still an issue,
Right.
6 to 9 months from now. And then the administration's they've kind of lost that, they kind of lost that ability. They have an opportunity here, I think, to just kind of be patient, let things happen for the run up into the midterms. But patience, we'll see. I suspect Bessent is more patient than Trump on this one. But Trump's the guy, so we have to figure out.
Right.
We got to try to figure out what he's thinking about it.
Well, great to catch up, Craig. Everyone have a wonderful weekend. I'm really glad September's here. We get back to business. Less time on the road for me, thank God. But thanks for everything this week, Craig. And anybody who wants to reach out to us at info@thebeartrapsreport.com for Washington pressure points, for a copy of our one idea to get into the Discord room. Reach out to us, and we'll talk to you next week.
Sounds good, Larry. Thanks.
Thanks. Okay.
Thanks, Larry. Thanks, Craig. As you guys heard, you need to get your copy now. Also, Larry mentioned Washington pressure points. This week we have a great intel, so the Washington pressure points for next week is gonna be awesome. You can't miss it. So remember, reach out to info@thebeartrapsreport.com. Also, our Discord chat is completely open for you guys. You just have to send us a message and we'll be happy to put you on. Our Bloomberg chat, we have the biggest buy-side investors in there. We have the biggest minds, and we have all that intel just for you. So if you're interested, do not hesitate to reach out, and we'll be happy to put you on. Thank you.